it's often the other market participants often are operating much more by art than by pattern recognition, because being in these inefficient markets, it's often families, it's private developers, it's people that have been used to, I drive down the street and I see a property and I'm like, I think I could do this with that. And well, if we just did a little bit of this or that, then we could get to where we want to go. And for us to come into those markets and operate with a very consistent, predictable process, it makes it much easier to identify those true gems versus rough ore. So today we wanted to talk a little bit about one of the key aspects of our strategy, which is pattern recognition and identifying patterns, how we identify them, and what we do with them. We always use pattern recognition in our day-to-day life. This is being a human, is having experiences and letting those experiences develop our intuition over time.
Yeah.
And so all we do regularly is apply that to the investing process, because investing, we believe, ultimately is a process, not an art. I think that's important. I think that's an important differentiation.
Well, what we're doing is sampling. We're getting sample after sample after sample, and we're looking for which ones stand out as things we should invest in. And so what are the criteria that create a sample or a process? Well, it's the various inputs about the current state of the asset. It's the inputs on what we think we can accomplish, and it's the timeline over which that happens. And that's going to lead to two things: an internal rate of return and an equity multiple. And so we're looking to be in the sweet spot of having actual inputs that we think are actually achievable, not too low. We're not sandbagging, and we're not
too aggressive.
We're not being too aggressive. And then having results that are acceptable. That in our case, high teens or low 20s internal rates of return, and equity multiples of 1.8, 1.9, 2, 2.1.
Yeah.
Ideally over 2.
Yeah.
So the question is, how do you find those things? And we talked in earlier podcasts about starting with submarkets where demand is strong. Usually vacancy is a few percentage points. Where prices are affordable on rents, where we think there's still some room to run, and where our investment cost, our price per door, or our price per square foot is well below replacement cost, 50, 60, 70% of replacement cost, which would suggest that there's still room to run against new supply. So we are looking for patterns where all those things intersect. And one key to this is you have to sample often. So I think we underwrite generally about 3 properties a week. It takes our analyst, a day or two to underwrite a property, and he usually has 2 or 3 going at any given time. Often we'll get a deal presented to us at one price point. We'll underwrite. We'll be at a different price point, but we put out offers. Because we're sampling too. Because each time we send out an offer and we get feedback, we're sampling how motivated that seller is. We're sampling how that market's changing. And sometimes we get a new piece of surprising intel that we can then factor into our models to have more expert level sampling and pattern recognition on the next few models.
Well, and it makes it much more of a science than an art when we have a regular filter that we're filtering everything through. And obviously that model changes, tweaks over time. There are certain, variables in that model that are related to that particular market, but it gives us this standardization so that as we're testing opportunities in a given market, we can build conviction around what is the right buy and what is not. And I think of the Salt Lake City one recently where, seemed like $150 a square foot made sense just looking at the market, and it seemed like that's what the seller's expectation were. So it seemed like a deal. And then we put that through our filter and it's $130 a square foot. And that it allows us to take the emotion and the art out of it and use that as a filtering. Obviously then as we get new market information or we get additional intel, that can change. But then that just goes on the shelf. That's an offer that sits there And, the broker gets back to us and says, well, it may take a little while for the seller to get there. And that just goes on our, figurative Ferris wheel.
An interesting part on that Salt Lake deal was it's a new submarket for us. We have one property there, and we're working on a second, third. But this seemed to fit within the mental model we had of what a property should sell for based on what the rents were achieving. On paper, this looked good. We modeled it, and the analyst sent back an email that said, we're just not there. If you come at this price, we're there. And he wrote a detailed reason for why we're getting these returns. And in this case, we just forwarded the email to the broker who brought this off-market deal and said, look, we love this deal. We're just not there. Maybe we're missing something. Let's do a call and figure out what we're missing. And after puzzling through it with the broker for a little bit, he said, I think it'll get to this. Let's put in the offer and let them go through a few months of their process. And I think there's a decent chance it comes back to us. So that is what we did. Time will tell.
Yeah.
But the main point is we saw something, we reacted to it, and we responded. And, maybe the tennis ball comes back over the net or maybe it stays over there. Who knows? We did our part.
Yeah, and in the markets where we operate, it's often the other market participants often are operating much more by art than by pattern recognition, because being in these inefficient markets, it's often families, it's private developers, it's people that have been used to, I drive down the street and I see a property and I'm like, I think I could do this with that. And well, if we just did a little bit of this or that, then, we could get to where we want to go. And for us to come into those markets and operate with a very consistent, predictable process, it makes it much easier to identify those true gems versus, rough ore.
So the part of the process to guard closely is the returns and what we're willing to buy. That part's pretty much unchangeable.
Yeah.
Like that exists. The part to guard loosely is what you're going to look through the lens at.
Yep.
So in a submarket, we are really interested in if a broker or a seller or somebody says, hey, you should check over there. Because, or hey, over there. Because when we look at it from the data, we see a thing, but there's a lot of little undercurrents happening there in that market. You could see at one level, but to get down lower, there's more detail happening. So the sampling is important, because sometimes you go places that it feels like, oh, that market's too high, overpriced, or sometimes the thing that's not is, and vice versa. So what we like doing is taking our lens and trying out different things. And by sampling in places that you wouldn't expect to sample, you learn new data that might lead you back to where you started or might lead you to a different spot.
Yeah, absolutely. Let's talk a little bit about pattern recognition on execution, because I think that's a key part of our investing. We're vertically integrated, meaning we have people on the ground at all of our properties. We have the property management, asset management, fund accounting, property accounting, construction management. And a big part of that is control of the process so that we are able to execute more swiftly. But it also creates this amazing feedback loop, because we have people throughout that process that are our team, understand our business plan, are aligned toward our outcome, and providing that feedback loop constantly in the market. Good example is, when we own one multifamily asset or whatever product type, but I'll just use multifamily. When we own one in the market, and then we're going to buy the second, the third, the fourth, now all of a sudden we have all of that real-time data from our properties to be able to help us, execute
tighten our underwriting.
More. Yeah, tighten our underwriting and execute more swiftly on the next properties as well.
Yeah. Especially it gives us more confidence and conviction around staffing and how we're going to execute the business plan, how we're going to achieve outsized results, often better than our competitors. So, or almost always.
Yeah. So. Yeah, and pattern recognition also extends to knowing the right asset to buy. Yeah. Because we speak to this a lot, but I think our primary demographic of seller is a private family that has owned a property for 10, 20, 30 years.
Yeah.
We've just learned over time that is almost always an opportunity for buying if the price can get to the price that we need.
Yeah.
So, when we hear that a property's been owned for 10, 20, 30 years, we're probably a buyer. We are a buyer at the right price.
Right. So normally, pattern recognition looks like a lead comes in some way. Now we're seeing it through the data. We're seeing it through CoStar and Yardi Matrix. We're looking at Google Maps. We're reading news articles. We're developing an idea around the property that way. After that, you go to the property, and when you drive up to the property, all the stuff you thought you could see from the data, you see in real time. You see the condition of the property. You see the roofs. You see you get a vibe for how the property is. Is it run down or well executed? Are people happy? Are they sad? Is there graffiti? Is there not? Is it well maintained? Is it not? And now after that, we then generally go to modeling it because it has to make it through those screens before it gets to the modeling screen. And once you've done all of that, now you just need to get to a seller who's willing to sell the price that makes things work. But it's interesting in that it's a long process, and you have to sample frequently from lots of properties, 10 or 20 or 30 to get down to one acquisition. And it's a beautiful thing. It's a thing we do well. It's a thing we've done for a very long time.
Thank you for listening to Durable Value, an investors podcast, where we demystify commercial real estate with safe, sound investment strategies to help you balance your portfolio. If you enjoyed this podcast, be sure to rate it on iTunes or wherever you get your podcasts. To learn more, visit GresetaPartners.com, where you'll find more information, investors tools, case studies, and more. This podcast is hosted by Joe Muratori and Ryan Suela. It's produced, edited, and mixed by Melodic, with intro music by Ian Post. Thanks again for listening, and we'll see you next time.